Two companies have the same stock price, same market cap, but one is buried in debt, while the other sits on a mountain of cash. Are they really worth the same? Market capitalization might be the first number you see, but it only tells part of the story. To uncover a company's true value, that's where enterprise value comes in. Today, we're breaking down two key financial metrics: market cap versus enterprise value. Explaining what they mean, their useful metrics, how they differ, and using simple examples to make it easy to understand. Hey there, this is Mavic Finance, where investing concepts are explained in a simple way. But first of all, a quick disclaimer. Let's start with market capitalization, or market cap in a shorter way. It's a simple way to measure the total value of a company's equity. The formula is share price plus total outstanding shares. For example, if a company has 10 million shares and each share is priced at $50, the market cap would be 10 million plus $50 equals $500 million. As you may know, the most popular index fund, which is the S&P 500, isn't just a list of 500 companies from the USA, it's a market cap-weighted index, meaning larger companies have a bigger influence on it. By the way, if you want a specific video explaining how this index fund works, let me know in the comments. The market cap of a company gives us a quick overview of what investors think the company is worth, but it doesn't tell the whole story. Which brings us to the enterprise value. Enterprise value provides a better meaning of a company's worth. It's not just about the stock price, it also includes the company's debt and cash. So, if an investor wanted to buy the company, they'd likely have to pay at least the enterprise value. This is because EV reflects what it would really cost to buy the whole business, taking into account both what the company owes and what it owns. The formula is enterprise value equals market capitalization plus total debt minus cash. Why is this important? Well, let's say two companies both have a market cap of $500 million. Company A has $200 million in debt and $50 million in cash. Company B has no debt and $100 million in cash. Now let's calculate enterprise value. Company A, 500 plus 200 minus 50 equals $650 million. Company B, 500 plus 0 minus 100 equals $400 million. Even though both companies have the same market cap, Company A is actually more expensive when you find its debt, while Company B appears to be a better deal. When a company's enterprise value is higher than its market cap, like Company A, it means the company has significant debt that increases its total valuation. This suggests that if you were to acquire the company, you wouldn't just be paying for its stock, you'd also be taking on its financial obligations. On the other hand, when enterprise value is lower than market cap, like Company B, it means the company has a strong cash position and little to no debt. This can be a positive sign, as it suggests financial stability and potential flexibility for investments or expansions. However, numbers alone don't tell the whole story. It's crucial to investigate why a company has high debt or excess cash. Is it investing in growth, struggling with financial challenges, or preparing for a strategic move? Understanding these factors helps investors make smarter decisions. Now that we understand enterprise value, let's talk about how investors actually use it to analyze stocks. One of the most popular ways is through EV multiples, which compare enterprise value to different financial metrics. Here are some of the most common ones. Enterprise value to EBITDA is a popular financial ratio used by investors to assess the value of a company relative to its earnings. It compares a company's enterprise value to its EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization. A lower ratio typically suggests that a company is undervalued, meaning you're getting more earnings for a lower price, whereas a higher ratio might indicate the company is overvalued. Enterprise value to revenue is another useful financial metric that compares a company's enterprise value to its total revenue. This ratio helps investors evaluate how much they're paying for each dollar of a company's sales. A lower EV to revenue ratio indicates a lower valuation relative to revenue, while a higher ratio suggests a higher valuation per dollar of revenue. However, this ratio alone does not account for profit margins, potential growth, or cash flow, so it should be used alongside other financial metrics. This metric is particularly helpful when evaluating companies that might not be profitable yet, especially high-growth businesses in their early stages, since EBITDA or earnings might not be meaningful for these companies. However, it's important to study companies that aren't profitable yet with caution, as they tend to be riskier investments. While EV to revenue can help you compare these companies based on their sales, it doesn't account for their lack of earnings or the challenges they may face in becoming profitable. Many of these businesses are still in their growth phase, and while they may have big potential, they also come with higher risks. Market cap alone can be misleading because it ignores debt and cash. That's why professional investors and analysts prefer enterprise value. It gives a fuller picture of a company's financial situation. If you found this video helpful, don't forget to like, subscribe, and hit that notification bell for more investing series. You can also check out this useful video. You won't regret it. Thanks for watching, and see you next time.